Hey, what's going on, everybody? It is Tuesday, May 24th. Not a lot to report today. Market opened lower on some weak guidance coming out of Snapchat. So this is kind of the environment we've been in for a while now. Companies issuing warnings, lowering guidance as they look forward to the second half of the year on revenues. And so we had another one of these downdrafts in the market today. Now I sent out early this morning after the opening, and we were down quite a bit. We erased, at least for the NASDAQ, we erased yesterday's gains. Dow, about 2/3 of the gains initially, and S&P also, we erased yesterday's gains. I sent out an email to subscribers saying, look, this is not, we're no longer in that April 18th to May 16th period where we were experiencing the negative effect from the cash drain, the tax-related cash drain. All right, this is a subject I've been speaking on now for the last couple of videos and explaining or attempting to explain to you how that liquidity drain, that cash drain related to April tax filings, and then that also flowed into almost like the second week in May, where we saw the federal budget running surpluses. That was significant, and that came right at a moment in early mid-April when it looked like the market was attempting to stabilize and move higher. But that liquidity drain, that cash drain, just took all the buying power from the market. And I said, as of basically May 16th, May 20th, let's call it, we have seen a recovery in some of that liquidity. The monthly deficit now, actually yesterday it shrunk down a little bit. We were 62 billion deficit as of last Friday. That was the 20th. That's good, and I said that we need to see that. But yesterday again, there was a small net drain of 14 billion. What do I mean by that? Like if you look at yesterday's daily treasury statement, tax deposits were 14 billion greater than withdrawals, than spending on yesterday. So that may explain today's wobbly market. Anyway, getting back to what I was saying, this morning I sent out an email to my subscribers saying the market should hold. All right, we should see a bounce back. I said we are no longer in the period from April 18th until May 16th. The liquidity flows have reversed to positive, and essentially that's what we saw today. Now, a little bit of a disappointment, I have to admit, on the S&P and the NASDAQ. They closed down, but they were off their lows. Dow closed up. But it's this kind of behavior, this kind of trading behavior that I want to see this. I mean, this is, sometimes I say you got to be kind of like a detective in this business and look for clues. If you have a hypothesis, then you have to look for evidence that your hypothesis is correct. And today, when it looked like we were going to have another one of these crazy wipeout days like we've been seeing so recently in the past, where we'll get a day up 400, 500, 600, and then the next day we're down 1,200 or whatever, completely wiping it out. So it started out to look like we were going to get another one of these days. But I have confidence in the numbers that I'm seeing, and that's why I sent out the email saying we're going to see about the market's going to hold and we're going to see a recovery. And we did, kind of. I mean, we definitely saw a recovery in the Dow. I mean, the Dow was down, what, almost 500 points, and it ended up almost 100. NASDAQ was down over 400. It ended up down like 270. You know, that's not great, but I mean, it's off its lows. But I said in the email that, look, we're not in this period we were from April 18th until May 16th when you had this net liquidity drain. We're in a positive liquidity flow right now, so you got to buy the dips. I was a little bit disappointed seeing that little drain yesterday of 14 billion. Again, you know, the only reason why you may notice, or you may have noticed, that, you know, I'm giving you these numbers on a daily basis now, whereas in the past, my videos for years, like, I really haven't had to go through this every single day because it was steady. You know, we were steady, not just running deficits, but increasing deficits at a steady rate. So the trend was like really, really positive. You know, I talk a lot of times about the swimming pool analogy. You know, over the last, you know, years, really, we've seen that swimming pool just continue to rise. The level in that pool just continue to rise and rise and rise. It's not like that anymore. I mean, we're you know, it's coming back from a total drain. As I said in a past video, or a couple of past videos, that, you know, that tax hit in April, that just took all the water out of the pool and then some. And then that lasted into the second week in May, and then it's finally starting to fill up. Yesterday I said, you know, it's about halfway full, and a little bit got drained out yesterday. So the reason why I'm giving you these numbers on a daily basis is because, you know, we're kind of on the edge. I have to say that, you know, these are not like, this is not a trend where, you know, I'm pounding my fist on the table saying everything is good and everything is fine. And, you know, we have good leading spending flows, you know, 600 billion plus per month. That's good. That's leading. But then you have that, you know, it gets sucked out to a large degree by the tax deposits. So I'm just giving you these numbers on a daily basis. It's positive right now. As long as it's positive, I believe strongly that you have to buy the dips. But again, these numbers have to be monitored almost on a daily basis right now. From what I see in the commentary out there, you know, on Twitter, on various other platforms and websites and blogs, etc., the so-called big money, the so-called smart money, and I use that term loosely, okay, because sometimes I question just how smart the smart money really is. But let's just go with that for now. The so-called smart money, I think, is correctly pointing out that, you know, the market is really, really attractive right now. Stocks are showing value that we haven't seen in a really long time. So the smart money is acknowledging that. And I think that's correct. I mean, if you look at some individual stocks of big names, you know, the degree to which they've been hammered down, I mean, there's tremendous, especially in the tech sector, tremendous value now has been rebuilt into those stocks. But those same people, all right, the so-called the smart money, they continue to cite Fed policy and inflation as a reason that nobody wants to go in and buy. Now, I take issue with that a little bit, as you know, because again, this is, for me, it's a matter of understanding. And I've been saying that I think the understanding is flawed in the sense that, again, it's, you know, it's a bunch of people looking at like one side of a balance sheet when it comes to interest rates or inflation, or looking at one side of the equation when it comes to interest rates and inflation. And I tried to point that out yesterday when I said that we see now JP Morgan and some of these banks citing higher interest income as a positive flow to earnings as, you know, they look forward into the year. And this is not something that's being, you know, universally mentioned. I mean, if anything is being universally mentioned, it's that high interest rates are negative. This is pounded home over and over and over again. Rising interest rates are negative. Rising interest rates are negative. Rising interest rates are negative. Yet here's JP Morgan, you know, our biggest bank in this country, saying, hey, it's positive for us. And there are many, many other entities like that, because as I've tried to explain in the past, that yes, some people pay more because the rate goes up, and some people earn more because the rate goes up. The money doesn't fly out into outer space. You know, I hate to beat a dead horse on this line that I use all the time, but it's you know, you have to understand this. The same with inflation. I mean, think about it. If you've been long energy stocks and that's it, if you've just held energy stocks, you'd be up big time in this inflation environment right now. I mean, that tells you right there that that is a clear example, real-time example of what I've been talking about, is that, you know, inflation isn't a one-way street. It's a two-way street. We pay higher prices, but somebody receives those higher prices. And again, as I said yesterday, we're in a global economy which is a closed system. Money doesn't fly out into outer space. It stays in the global economy. You know, how often I mean, I have a trading background, so, you know, first thing we used to do when we came in the morning as traders was like, you know, what's happening in Europe? What happened in Asia? Like, there's a flow. You know, we looked at those things first to get a call, a handle on how our market was going to open. I mean, now you have 24-hour trading. I mean, back when I started, there wasn't 24-hour trading really. So like, we had to have a call. What's the call? We used to come in. What's the call? Is it up? Is it down? How much? We used to how did we determine that? We used to look at what the foreign markets were doing. So it's a closed system. So yeah, the big money, the smart money, they're acknowledging the fact that there's deep value in stocks right now, but they don't want to go in because of Fed policy. Everything is about the Fed. This is, I mean, I'm coming back to this again, how monetarism is a mental illness. It's this kind of psychosis that has gripped the investment world, the financial industry. Everything revolves around central banking. Nobody pays any attention to fiscal policy, to the things that I talk about. For everyone else, it's universal. Their world, their entire understanding of how everything operates revolves around, you know, the central bank, which is basically, I don't want to say it's irrelevant in the picture. It's relevant to the extent that the belief system attached to central bank policy is very, very strong. The belief systems attached to central bank policy very, very strong. In other words, how people behave because of their beliefs about what the central bank can and can't do. It's very, very strong in terms of, you know, a reaction function. But it's mostly completely wrong with respect to the reality of how things work. But I have to take that into account. I mean, you know, behavior, it's like the stampede, the herd effect. I mean, you don't want to go against that, or if you do go against that, you have to understand that this kind of, you know, this reaction, the herd reaction, the herd mentality can persist over a period of time. So there you have it. I mean, I still think as long as these flows stay positive, even if it's kind of like, it's a slow flow right now. And by the way, if you think about it historically, because we got jaded, let's be honest. I mean, after the last 2 years of almost 3 trillion deficits every year, you know, deficits approaching 12, 13% of GDP, we got jaded. Like, you haven't seen that kind of stuff since 1941, since World War II. Okay, when the entire country was mobilized to fight a world war. I mean, so like we got used to that kind of flow of last March we had almost $1 trillion in spending in 1 month. Okay, and now like, oh, it's 620 billion. That sucks. Oh, but 600, like it used to be like, it used to be like 300 billion was the average, and we were like, this is great, and the market was going up. And then with Trump, the whole entire term of the Trump presidency, with the exception of his last year when the pandemic hit, it was running 420 billion, and the market was fine. It was going nuts, and the economy was, we were growing like 2.5–3%. It's basically what we're doing right now. So 600 billion. I had a guy send me an email today. Said, Mike, the government's not spending. Well, they're spending. We had 4 months in a row over 600 billion. I mean, that's the most we've had in a year. You got to go back to like last April, May, June, July to see numbers like that. So I mean, we're just jaded, and it's like got used to the fact that the fiscal pump was operating with such pressure, such power, that I mean the market went straight up after the pandemic. I mean, you talk about, that was like a super pumper. It was incredible. So now it's coming back down to a more of a normal level. Again, if you want to talk about deficits, like, if it were not for the pandemic, when we started to run up these $3 trillion deficits, we're going to have a $1 trillion deficit. We're going to have probably a $1.2 trillion deficit this year, something like that. Even if it's under $1 trillion, let's say it's 700 billion, right? 750 billion. I mean, historically, if we didn't get used to the 3 trillion ones, we would have been like, oh my God, it would have been all over the news. Now it's going to be reported like, hey, the deficit shrunk so much, it's only up it's only 750 billion or whatever it's going to end up being. So, I'm trying to put this thing in perspective for you. The headline for me, and what I sent to my subscribers today, the headline of my email is in the subject, it's not April 18th to May 16th anymore. We're in a positive liquidity flow. Under that condition, you got to buy the dips. All right, everybody, that's it for me today. See you tomorrow. Bye.